August 19, 2026 is the day when 50% US tariff hits Canadian businesses, and it is paused until August 21st. So what happens next? Today I am running the actual math on what this tariff costs a business like yours, not the number in the headline, but the actual number that hits your business. By the end of this video, you will know exactly how to check your own exposure, and you will walk away with 3 concrete moves that you can make this quarter to protect your margin. Practical steps you can take before next purchase or sales. Quick note before we get into it, this is a financial entertainment and education, not financial advice. I'm sharing what I have learned myself, what I do myself, not telling you what to do with your own business. Please consult with your accountant before making any decision. Okay, let's start with what is this 50% tariffs actually is, because most of what is floating around online right now is only half of the picture. As of August 21st, the US applied this tariff under Section 338 of the Tariff Act of 1930. The legal trigger was alleged discrimination against US commerce. That matters because it is a different mechanism than Canada-US-Mexico agreement, or in short, CUSMA related tariff we saw before, and the different mechanisms mean different rules for who is exposed. Here is what is covered: dairy inputs, alcoholic beverages, electronics, machinery, wood and paper products, chemicals, textiles, plastic, furniture, and many more. Depending on the specific proclamation your goods fall under. Here is what is exempt: energy products, potash, fish, critical minerals, and anything already sitting under existing steel and aluminum tariffs. It is basically a legal tool the US government can use to apply tariffs when they decide another country's trade practices are treating US business unfairly. It does not need the same kind of ongoing negotiation process that a lot of trade tariffs go through, which is part of why this one landed the way it did. And here's the part that catches people off guard, and it is the single biggest thing I want you to walk away from this section. In past rounds of tariffs, if your goods were CUSMA compliant, you were usually fine. That protection is why a lot of Canadian businesses built their supply chains the way they did, sourcing and selling across the border of US without worrying too much about tariff exposure. Not this time. CUSMA compliant goods are not automatically exempt from this one, and that is a real departure from what a lot of business owners assume will protect them. That CUSMA assumption is actually the single biggest mistake I'm seeing right now. Owners hear I am CUSMA compliant and figure that settles it. It doesn't settle with this tariff. What actually matters is your specific harmonized tariff schedule of United States, or in short, HTS product code. The number that classified exactly what your goods are, not your general compliance status. 2 products that feel similar to you as a business owner can land in completely different categories once you look at the actual code, which is why guessing is risky here. You can check your own codes through the Canadian Federation of Independent Business, or CFIB's tariff search tool, and I will leave the link in the description below so you can look yours up today and see the tariffs for affected products and at what rate. Direct exposure is goods you personally import or export, the ones that physically cross the US border under your business name. Indirect exposure is different, and it is the one that sneaks up on people and harder to track. Say your supplier in Ontario builds the part you use, but they import a component from the US to make them. They eat that tariff and then they quietly pass it on to you as a price increase on your next invoice. Think of it like a slow leak in the tire, not a blowout. You are not going to feel it on one drive. You feel it 3 weeks later when you are stranded on the side of the road, wondering how you got there, because nobody checked the tire pressure back when it still would have been an easy fix. If that sounds like it could be you, drop a comment below and tell me, what is the one thing your business sources from the sales in the US? I'm genuinely curious how many of you are actually exposed here. Let us make this concrete with a simple example. Say your business brings in roughly $10,000 a month in US sourced goods. That 50% tariff applied to your landed costs, meaning what you actually paid to get those goods out of the door, including duties, not your retail price. 50% of $10,000 is an extra $5,000 a month, which works out to be $60,000 a year, coming straight out of your bottom line if your pricing does not move. Now picture a business running a typical 20% margin on that revenue. Before the tariff, that is roughly $2,000 a month in profit. An extra $5,000 a month in cost does not just shrink that profit, it wipes it out completely and put the business in red, unless pricing and sourcing changes. That is the gap between the headline number and the number that actually lands in your income statement. To be clear, this is an illustrative example to show you how the math flows. Not a specific client's number, and your real exposure depends entirely on your own product codes and supplier mix. If you want to find your own landed costs and add up what you paid for the goods themselves, plus shipping, plus duties, and this tariff when it applies, before you compare it to what you are actually charging. So what do you actually do about it? 3 moves. 1. Reprice deliberately instead of reactively. Know your new landed cost before you touch the price list, not after. Businesses that guess at a price bump usually either undercharge or keep bleeding the margin, or overcharge and lose customers they did not need to lose. 2. Go back to your suppliers and renegotiate or requote, especially anywhere you suspect indirect exposure might be hiding in your input costs. A lot of owners never ask and just absorb whatever their supplier passes along, when in reality that cost increase is just as negotiable as any other line item on the invoice. 3. Time your purchases and shipments around any relief windows or negotiation news, since none of this fully settled yet, and the timing of a large order wrong can be an expensive mistake to make twice. If a big order can reasonably wait for a few weeks while things shake out, that patience can worth real money. If your goods are being re-exported or are not staying in Canada, look into the duties relief program and the drawback program. Worth checking even if you're not sure you qualify. If breakdowns like this are useful to you, please hit like and subscribe so you can catch the next one. Beyond those 2 programs, there is more support out there if your business is affected. The Regional Tariff Response Initiative offers financial support for small and medium businesses, though the process and eligibility vary by region. There's also Strategic Response Fund and Tariff Remission Request process for exceptional relief cases where the standard programs do not fit your situation. On top of that, CFIB runs a tariff hotline, and most provinces have business navigator services that can walk you through your specific situation with someone who actually knows your file. One honest caveat here, because I would rather you hear it from me than get caught off guard. Trade talks between Canada and the US are still ongoing, and the specific of who qualifies for what can shift as those talks move. Always check the link in the description for the updates. Last thing to mention, this is where cash buffer can save your business. Think of a buffer less like a savings goal and more like shock absorber. It does not stop the bump from happening, it just keeps the bump from reaching your whole business at once. So one bad month does not turn into a bad year. Personally, I keep my own business buffer in Wealthsimple. It is simple to set up and it is genuinely what I use myself day to day. The link is in the description below and you can earn $25 if you are using my link. It is an affiliate link, so I may earn a small commission if you are using my link. So here's the recap. The number that actually matters is not 50% headline. It is your landed cost. Check both your direct and indirect exposure, not just the shipment with your name on them. Do not assume CUSMA protects you this round, because this time it does not automatically. Reprice deliberately instead of reacting, and know the relief programs are before you need them, not after. Here is your next step this week. Pull your actual HTSUS code, run your own landed cost math using what I show you today, and bookmark those relief programs links in the description below before your next order or invoice goes out. None of this takes more than an afternoon, and it is a lot cheaper than finding out the hard way 3 months from now. If this helped you make sense of your own numbers, that is what this channel is for. I will see you in the next video. Bye.